Hello and welcome to this video on the circular flow of income. So we've looked so far about how we measure the size of our economy, the concept of GDP, whereas now we're going to look within our economy. What affects the size of it and how does money flow around the different parties within our economy to try and have a better understanding of the functions that are going on. And in order to do that, we're going to look at three things: the difference between income and wealth, the circular flow of income model, and then we're going to look at using this model to analyze the impact of changes in the economy on the size of the economy. So let's start off. We're going to talk about the circular flow of income, and to do that we'll be making reference to this concept of national income. Now, national income measures the total amount produced by an economy in a given time period, so a very similar concept to GDP. And there are three ways in which we can talk about national income. The one that's similar to GDP, adding up the total value of output in the economy. But we can also measure it by looking at how much has been spent in the economy. If we know how much has been spent in total on goods and services, that's going to equate to the value of goods and services that have been produced. And if we know that the money has been spent on these goods and services, then that must have been earned by someone within the economy. So we can also add up the total income. So within our minds, we should have it clear that total expenditure, money spent by households, will be approximately the same as the money earned by firms. So that's the concept of national income. Our first objective was to look at the distinction between income and wealth. And a bathtub metaphor is quite a good one to use here. If you imagine that how much you own, how much you have, is the level of water in the bath, that is your wealth. And then any inflows we would call income, anything leaving the bathtub we would call expense. So income flows in, adds to wealth, and expense flows out and reduces wealth. But wealth is kind of how much you have or possess, what you're worth. As an example, as economists, we would describe wealth as a stock concept. So wealth is a stock of assets, whereas income is a flow of money from an asset. So for example, a house would be an asset that would contribute to your wealth, the value of that house, but a flow of income from it might be rent, if you were to rent out that house. Savings, the amount of money you had saved in a bank, would be a stock of money. That would be an asset that you own. But the interest you receive from your savings, again, would be a flow, an income flow coming into you. If you own shares, the shares themselves would be wealth. The value of those shares would be a stock of assets. The dividends, the profits you receive from owning those shares, that would be a flow coming into you, income flow that would increase your wealth. So we have to get this idea in our minds that in this one in this concept, we're talking about income, and that is looking at the flows of money around the economy, not how much the economy is worth in total, the wealth of the whole country, but just the flows of money between households and firms in the first instance within the economy. So what is the relationship between income and wealth? Well, if I was worth £1 million, my income was £30,000 and my expenditure was £30,000, will I get any wealthier? The answer is no. My income is the same as my expenditure. If I was worth £1 million, my income was £30,000, but I was only spending £10,000, would I get any wealthier? Well, in that situation, yes, I would. I'd be getting wealthier by £20,000 every year. So if income increases are going to have a direct impact on wealth, then you must make a decision about spending less in order to enjoy increased wealth and welfare in the future. Okay, so we've looked at the difference between income and wealth. Now let's look on at the main part of this topic, the circular flow of income model. So the circular flow of income is a model of the economy which shows the flows of goods, services, and factors and their payments around the economy between households and firms. And by factors here, we mean things like labour, we mean things like entrepreneurship and capital that are provided by households. So we're looking at how money flows to firms for goods and services, how it flows to households for providing workers, and those sorts of things. And it is a model. And what do we mean by that? Well, certainly not these guys. That's perhaps a little closer in that it's a simple representation of something. But we're looking here at an economic model, a kind of simple layout that shows us the relationships of the concept we're trying to study, the workings of the economy. So the circular flow of money model looks a bit like this. Now, this is quite complex. Don't try and take this all down just yet, but we're going to be looking at the relationship between households and firms within the economy, and then also introducing the government and the rest of the world. So we're going to build this model up nice and slowly from the start, and then I'll give you a choice of which diagram you'd like to take down. So let's imagine a very simple economy in which we have firms who manufacture products for consumption by households. Okay, so our basic economic system involves firms making goods and services that are consumed, used by households. And the firms doing that work are set up by people from households. They use workers from households. They use resources that have been provided by people. So there is a relationship here between households who provide what we know as the factors of production, and firms take those factors of production, turn them into things that we want, and those things are consumed. Okay, so that's the flow of stuff, if you like, of goods and services and factors of production. We can also now attach money to this. So when households consume goods and services, there is money that flows in the other direction, and we would call that expenditure. So households spend money, and that money goes to firms. Now, if you think about it, what then happens to that money within a firm? Well, maybe they would pay their workers, or maybe the profits would go to the owners. Effectively, that money would flow back to the households at some point through either rent or wages or profits. So here we have a constant flow of money going around the economy. Households spend money which is earned by firms. Those firms return money to people who live in households, and the process continues. So if we're going to measure the size of our economy and GDP, national income, we can use this concept here, because the amount being consumed by households, the consumption of goods, equals the output of the economy, which also equals how much is being spent, which also equals how much is being earned, which would also equal GDP. So looking at just one of these parts of these flows would give us a concept of the size of the economy, the level of GDP or national income. So we're going to broaden this. This is what we call a simple closed economy. All we have is firms and households. But in reality, it's a little bit more complex than that, the flow of money around the economy. We're going to introduce three different sectors. The first sector we're going to introduce is the financial sector. And what that allows firms, households to do is to save money. Now, when they save money within a bank, the financial sector, that will reduce potentially how many goods and services they consume, because the money is not being spent on goods and services, it is being saved in a bank. However, the flip side of that is actually banks also provide a secondary role, not just for saving, but also for lending. And typically firms might borrow from banks, borrow money, and use that money to spend on resources or increasing their scale of production. So investment by firms would actually be increasing the consumption of goods and services. The next sector we're going to introduce is the government sector. So the government collects taxes primarily from households, and when they do that, if a household pays out tax, that reduces the consumption of goods and services, because that money can't be spent on goods and services, it's being collected as tax. The flip side of that is often governments spend money themselves. The money they've collected as tax, they might spend on infrastructure projects, for example, something like Crossrail or High Speed 2, and that money would be increasing the consumption of goods and services. So governments can increase consumption of goods and services through their government expenditure. So we have the financial sector impact, the government sector impact. The last sector we're going to look at is the external sector, which we relate to foreign countries. So if our households buy imports from abroad, that is money that is not going to be spent on domestically produced goods and services. So this flow here of money going abroad will reduce how much is being consumed domestically. The flip side is if people buy stuff from abroad, from our country, domestically, then that would increase the consumption of domestically produced goods and services. So now we have our circular flow of income, and it's a little bit more complex now. We have the domestic relationship between firms and households, but we also have these three other sectors operating within our economy. Some of them, all of them can have a net, what we would call withdrawal effect, where money is withdrawn from the economy, and they can all have a net injection. They can actually all inject money into the economy. So these arrows in blue, we call those withdrawals from the circular flow of income. And the arrows in brown, we call injections into the circular flow of income. And that's our circular flow model. We can estimate what's going to happen to the level of GDP, the consumption of domestically produced goods and services, or national income or expenditure, by looking at this model. If there was an increase in net saving, that would be a withdrawal from the circular flow. We maybe expect GDP to fall. If there was an increase in government expenditure, that would be an injection into the amount of money flowing in the economy. We'd expect GDP perhaps to increase. So we need to take these diagrams down, and you have a bit of a choice. This is the first diagram you could take down. Again, you can see the relationship here between households and firms and the government. Again, with the rest of the world, if you like the look of that one. You can take down the one that we've just done. Perfectly good diagram. Again, it explains the circular flow. Or if you want something a little bit more simple, perhaps, you could take down this diagram. Again, we have the relationship between households and firms. We have withdrawals, money leaving the circular flow in our economy, and we have injections, money entering the circular flow in our economy. So you might want to pause the video, make sure you've got one of these diagrams down, maybe back up if you need to have a look at other ones. And then we'll move on. So one of the key things we can do, why this model works particularly well, is because we can use the concept of injections and withdrawals within the circular flow to estimate what's going to happen to the level of output, GDP, national income within our economy. So there are three types of injection, of extra spending into the circular flow model, and there are three types of leakage or withdrawal. Sometimes you hear the word leakage, money leaking out of the circular flow. So the injections that we need to be aware of: investment by businesses, which will be influenced by things like interest rates; exports of goods and services, that's money coming into the circular flow, which will be influenced by the exchange rate; and then we have government spending, which again will be influenced by the government's finances and maybe the political outlook of the party. So these will be sources of money flowing into the economy, injections that would increase the circular flow. Withdrawal, money leaving the circular flow of income, we've got saving. If people, households decide to save within a bank, that would be a withdrawal. If there's imports of goods and services, that money is leaving the economy, that would be a withdrawal. And again, if there's taxation within the economy, that money is leaving the economy, not being spent on goods and services, again, that would be a withdrawal or a leakage. So let's make sure we've got these down in our notes. So let's talk a bit more about injections and withdrawals within the circular flow of income. If injections are the same as withdrawals, our circular flow is going to be in quite a steady state. That the amount of money flowing around the economy will be fairly balanced, and we describe that economy as being in equilibrium. There is no increase, there is no decrease. Injections are balanced with withdrawals. If injections are greater than withdrawals, then the national income will rise. The money flowing around the circular flow will increase, and we would equate this with economic growth. Lastly, if withdrawals are greater than injections, then national income will fall. There'll be a fall in real GDP. So let's have a look at some of the impacts of changes in the economy. This is what we can do with this model. We can say, right, what would be the change in the economy of if something happened? So the first scenario, an increase in the interest rate by the Bank of England. So I'd like you to maybe pause the video for a second and think about, do you feel this would affect withdrawals or injections? What would be the effect? Well, an increase in the interest rate might make it more attractive for households to save. So there would be an increase in savings. The flip side of that would be actually it's probably less attractive to borrow money to invest. So there might be a reduction in investment. So in this case, we've got withdrawals increasing and injections reducing. So withdrawals are going to be greater than injections. This we would predict to have the effect of lower national income. Okay, what about this scenario? A fall in the value of the pound. What would we predict would happen with injections and withdrawals? Well, a fall in the value of the pound is likely to reduce the amount that people are importing. So that would reduce that withdrawal of money from the economy. At the flip side, a fall in the value of the pound is going to make it more attractive for foreign companies or households abroad to buy products from our country, from the UK, and so exports would be increased. So in this scenario, we've got an increase in injections and a reduction of withdrawals or leakages, so we'd predict higher national income or GDP. Okay, a last scenario now. What if the government cut income tax? Well, if they cut income tax, we would see a reduction in the withdrawal. But again, here, not necessarily going to see any flip side change in injections. It doesn't have to always be balanced out by a change in injections. So here we've got lower withdrawals. We might expect higher national income, more spending on domestically produced goods and services. So in this video, we've looked at the difference between income and wealth, and then we've used this concept of income to look at the flows of income around the economy, and then using the idea of injections and withdrawals to predict what might change in our circular flow. And lastly, we can use this model to look at the impact of economic changes on the circular flow and make predictions or try and explain increases in national income or GDP. That's it. Thank you very much.